in the middle. What's going on, Payson?
What's going on? We're doing good. We're back.
We are back. Today, we do have a new piece of equipment that we're utilizing. So if you notice that the camera looks a little bit different, it's because it does. We have a new product that we're utilizing called the Logitech Mevo. So
we're giving it one shot.
We're giving it a one shot. There's some YouTube shorts that are going to be coming out soon. We've already recorded them from the first day we opened the box, and I kind of let loose on it. And then I came to my mind. I was like, well, let's try something else really quick. And then I was like, oh, don't send those out. I said too much bad stuff without double checking. Today's special guest is the unicorn.
Welcome to the podcast.
Welcome to the podcast, Sophia. Hi, as usual. If you this is your first time tuning in, there's a new toy that my daughter asks to bring every podcast, so that's going to be the new tradition going forward. Before we get started today, we want to thank our sponsor, USCCA, and if you want to learn more about the USCCA, click the link below. And before we get started, we're going to play a quick video from our sponsor.
It's in our nature to protect the ones we love, to stand up to any danger, to be strong and courageous, to always be prepared, to keep our family safe, to be the first line of defense. We are born to protect.
Chills. Today's topic is actually going to be about what, good sir?
Lending and lending misconceptions.
Right. You know, Payson and I spend a lot of time outside the office messaging each other and sending funny videos to each other. But there's one thing we have in common, which is watching bullcrap. And I'm not going to say the situations are bullcrap. I'm going to say that
it's just the
probably
the way they word it.
Yeah, the way that they paint the scenario.
Yeah,
is definitely not what it seems.
Because I'm sure like things are happening, but to that level or to that extreme is probably where it's like, okay, how?
and I have an example that we're going to play today. And this gentleman, he's on YouTube quite a bit. His name is Ryan Pineda. I don't actually know who he is. Payson seems to know who he is because he keeps up to this stuff more than I do. Apparently, he's some sort of very young entrepreneur. And again, I don't doubt the validity of his success and or acumen around what he does. However, coming from a finance perspective, where I was in the banking industry for almost a decade, I can tell you that those type of deals don't happen. I've been on the back end of those deals. I've been on the phone with underwriters. Hell, I've even tried to make deals for myself happen. They don't. Now, from a private perspective, we offer private money lending here, real estate investment lending, hard money lending, regular loans, private loans. So I have a pretty good understanding of what it takes to make those deals close too. So I'm going to play a video, and then I'm going to give my play-by-play on what I believe to be a little bit false. Again, the situation may have happened, but I do not believe that it went in the direction that the way that the podcast that he was on stated. So I'm gonna just play this, and then we'll talk about, a lot of the lending misconceptions that are out there, because I'm starting to see this out there more. And what's worrying me is that whether you're young and impressionable or in your 20s or in your 30s, or hell, even some of our clients have asked us questions like, is this even legit? How is this? I'm hearing this everywhere. And it's like,
how is this even possible?
I'm like, the internet's not a place of truths all the time. But I'm going to go ahead and play the video, and we'll be in our little, this video was called, I Bought 10 Units for Cheap. Okay. Which again, I do not doubt that he purchased these 10 units. Mm-hmm. I want to emphasize that, because I can already tell if some of his fans come here, they're going to think we're talking trash. That's not the case. I'm just coming at it from a lender's perspective and the reality of how that deal would to truly be structured that way. So let's go ahead and play it.
I got $300,000 apartment with $16,000 down and no payments for 3 years.
No payments on 3 years. Who would do that?
We are cold calling, trying to find deals. This seller picks up. He's like, hey, I don't want to sell this house I have, but I own this 10-unit apartment. This was 3 years ago. I didn't know anything about apartment investing. And I go, we'll buy an apartment. Like, if the deal's right, we'll figure it out. We go there. It's in a really rough part of town here in Vegas. He's like, hey, I haven't gotten rent in 3 years. Okay, that's not good, but it's also a sign of motivation. We go there and we see it's just like really bad. Gang banging, like selling and stuff, like legit. We also noticed that one of the units burnt down. Like, he didn't even know.
He didn't know that one of the units
No,
burned
he had no idea.
How bad was it?
Everything inside burnt to a crisp. I end up calling him. I'm like, hey man, this is a bad situation. Did you know that a unit's burned down? He's like, what? Couldn't believe it. Out of state owner in California. I still didn't really know what it was worth. I don't know how much renovation it needs. I have to get it for a crazy deal. I end up just offering him $200,000.
Gosh.
So I'm gonna go back to our camera here. There's a lot to unpack there, right? And we're gonna just start right out the gate. He purchased a $300,000 10-unit apartment, but he only put $16,000. Okay, that would be a little bit more than 3%. Now this is a rental investment property, so he couldn't have gotten it at 3% because FHA is for first-time home buyers. So 3% is already out the door. There's just no way. Private lenders won't take a deal for 3%, especially on commercial property. The fact that this thing wasn't rented for 3 years, and we're going to go back to the not paying rent for 3 years, because I don't buy that at all. The thing hadn't been rented for 3 years, right? Let's think about that. The NOI on a building that doesn't have anything for 3 years is zero. It's actually net negative, right? Because there's still an upkeep to that building, whether it's in property taxes, whether it's in, I mean, it's all tax related. Even if this person owns it free and clear, the NOI is net negative. So there's no lender who would look at this property and say, sure, 3% is all I want down, unless it's a private seller carry the note.
That's what this one was, right?
Sure.
The seller carry.
It sounds like this one was. The seller may have carried the note. I have never met a seller who would carry a note at 3% and refuse payment
For 3 years.
for 3 years.
Yeah.
A lot of embellishing, I believe, in this story, and will continue. A minimum needed for any sort of private hard money or even a seller carrying the note, we're talking, depending on the size of the deal, 15 to 30%. Because right out the gate, SBA, with their 504, their 7A loans, they're all between 10 and 30%, depending on the type of building, what it's classified for. Again, specialized buildings are harder to sell than regular buildings. Like an apartment is going to be a lot easier to sell than a restaurant because it's plumbed a certain way, or a dental office. I did a lot of medical offices, and dental offices were a very common one where they're plumbed a certain way. You can't just put a bunch of cubicles and then office workers come stay there, right? It's considered a specialized unit because only really meant for dentists.
Okay.
Unless that person were to do what's called a commercial loan with TI, and that's TI stands for tentative improvements. So the way that we would structure those deals were, we would give the money for the loan to purchase, and then we'd give them an allotted amount to do construction, tentative improvements. So if somebody
Is that kind of like, I could be wrong, but is that kind of like, isn't there like, is that a bridge loan technically of some sort?
No,
not
they
necessarily?
can. The term bridge loan just means a short-term loan for me to use while I pay it off. A short-term
I gotcha.
turnaround. Most SBA stuff is not bridged. Most banks don't bridge anymore. Private companies will do a bridge because they're really short-term. This is just like, hey, we're going to lend you X amount of money. You can use this to do construction. But while you use that money for TI, tentative improvement, the bank or the lender actually has to come and verify.
Okay.
In stages. So they get documents from the construction company, then they have to go and check the phases, then they have to submit pictures because they release the money in waves. So if you get approved for $300,000, they don't just give you $300,000 and say enjoy.
They may give you $100,000.
Yeah, they'll give you 103 phases, and then they're working with the construction company too, because the construction company builds it out, and then they go, okay, we're gonna do phase 1. So then the bank now sends a rep, take pictures so that it supports the need for the rest of the money. The thing not taking rent, I don't believe that. I don't think if somebody who hasn't received rent for 3 years would not take $16,000 and then also continue to not want to receive rent
for another 3
for
years.
3 years. At this
'cause
point,
they'd just
he's
be putting
totally writing
themselves
it
in the
off.
hole.
Right. I mean, he's already in the hole on this property.
Yeah.
So that leads me to believe that the owner of this property doesn't need the money. And as a matter of fact, the write-off, it probably benefits him more than anything else. Because if it was burning a hole in his pocket that he cared about,
Yeah, he would.
he wouldn't be passively just not caring for 3 years.
Right.
Another thing that was covered is like he had to call the owner to tell him that the place was on fire. That doesn't happen. The first thing that happens when a fire breaks loose, first and foremost, is the fire department looks for the neighbors if they can't find the owner, and they go, "Hey, do you happen to know who this is?" And I actually, before talking about this, I talked to a fire marshal who's a buddy of mine, and I said, "In what world would you never tell the person that his building went up in flames?" This doesn't happen. There is no world in which this happens. He goes,
Right.
"We have all the resources in the world to figure out where that owner
Well, I
is."
guess you could even go back to our sandblasting thing. That
Yeah.
wasn't even a building, and they called us. They found a way to get a hold of us.
Exactly. You guys had arson done, and they called you within.
And we weren't even
within
the,
the,
we weren't even the owners. We were just renters in it. And
Right.
they still found our numbers.
That's what I'm saying. It doesn't happen. So when he's like, "Oh, I had to call the owner and tell him that his building," and he's like, "What? My building's on fire?" It's like it's an embellished story. And again, he probably bought that building, but I would imagine he bought that building with a crew of investors and a bunch of people on the back end, and much more expensive than $16,000 down. This huge misconception that's going out right now is that you don't need money. You only need 15 grand to own a $500,000 building, but it's not that way. There's a lot of factors that go into lending, and this is across the board. It's not just with real estate, it's any sort of lending. You have aggravating circumstances such as CLTV, DTI, and I'm going to explain what these are, but I'm just going at it from a technical standpoint. LTV, DTI, and you understand this because you do real estate, primarily. So you can't just walk up and say, well, even if it's $1 million building, I'll give you $30,000, 3%. You give me this loan for this building. The bank's not going to go, sure.
Yeah.
They're going to go, well, hold on, bud. We got to check credit. We got to check DTI, debt to income. We got to check CLTV, commercial loan to value. And these factors have to meet certain parameters, or you don't qualify for the loan. Plenty of adults out there are listening who purchased their home pre-08, don't know anything about this debt to income, CLTV, Fannie Mae, Freddie Mac. That doesn't exist then. That was all stated income. But anybody who's purchased a house in the last 5 years knows what a pain in the ass the process is.
Yes.
I've talked about this in other podcasts. I worked for the bank that I got my original home loan through, and even then, that was a pain in the ass. I had to get
it's a
involved.
huge ordeal.
It's like, it just doesn't make sense. You have to have certain thresholds of income to support that payment. The bank doesn't care that you have $30,000 cash now, because after your $30,000 cash, do you even have cash flow to support whatever needs to be done to this building? Going back to that Ryan story, the building was engulfed in flames, right? That's what he said. It was from inside and out, it was charred up. If it's truly been charred up, then it's not safe to live in, which means that it has to be demolished, that section of it, and rebuilt. So, this $300,000 10-unit apartment that I only paid $16,000 for, and 3 years no payments, there's not a world. You probably bought the thing. Maybe you did buy it for $200,000 because the seller said, "You know what, I'm done with it." But that would be more MLS record to check, because we don't even know what the address of this property is.
If it even went on the MLS too.
And yeah, exactly. Even if it even went on, and depending on what the deal was, but it doesn't just stop there. How much money do you have to put in this thing? Because he said it's a crack house, it's a ghetto, gangbangers everywhere.
Yeah, and then you consider reconstruction for the fire. It has to be
Exactly. Where does that money
way
come
more
from?
than what the building's worth.
This is the misconception. The story that he's telling is $16,000 got me $300,000 10-unit apartment. Everybody needs to invest. $16,000. I'll even humor this situation where this deal happened in the way that it's stated. $16,000 for $300,000. We're not even talking value. $16,000. this place is demolished based on what it looked like from the fire. Okay, permits are going to cost you a good 10 G's, 5 to 10 G's. Renovation cost of construction, getting it approved from the city. We're talking maybe another $30,000. That's just for the one. The other building, the rest of the units are probably not up to par either.
Yeah,
because if this has
it's
been
been
a
a crack
den
house
of,
and
if it's a crack house and a
everything needs to be
gangbanging
probably torn
hub
out.
and a den of homeless, this thing is trash. Nobody's gonna pay to live there. They're gonna want to clean it up first. 16 grand quickly turns into over $150,000-$200,000 in renovations to make what they call passive income, which it is
I would
passive
imagine, 'cause
income
you probably need realistically at least 20 to 25,000 a unit probably to make it
for sure.
make it even
you can't. If
subpar.
the average cost of, and we work with a lot of construction companies, and the average cost of renovations for a bathroom, a single bathroom, is upwards of $50,000 now.
Wow.
Like the average between 30 and 50. Kitchens, 50 to 70, with the cost of labor, with the cost of material, with everything included. Even if he's got his own crew of people, which I'm sure these guys do. I truly believe that he goes in with a group, which is okay.
Yeah.
Grant Cardone does this as well, where he portrays
I
him
know
buying.
this guy, because this guy, I know his background, he started in fix and flipping homes. So he has a massive, I think, general contractor crew, or at least he's familiar with general contractors. So he works with some, I'm sure. But yeah, I think it's the saying it's $16,000 and that gets you.
Well, it's really deceptive. And my biggest concern for the young, impressionable people listening is it sounds really enticing. Hell, it sounds enticing to me.
Yeah.
I'll throw 15 grand at something and be worth 300,000. But the reality is it's more than that. I think the problem is when people are talking about debt and the misconceptions of debt, it's understanding that the debt doesn't just stop at the down payment. No. There's a lot of factors that come with it. There's interest rates. There's fees, there's state licenses, there's all kinds of things that have to be maintained. There now has to be insurance on this building. This building can't be uninsured, right? And then that's another thing. So has this building been uninsured this entire time to where it's been on fire and nobody's collected the insurance money? Honestly, if I was an owner and I had a building that hadn't been rented in 3 years, and it's a crack house and a homeless den and whatever he was saying, gangbanging central, whatever, I would be more than happy that this thing caught on fire.
Yeah.
Because at least some way, somehow, I'm going to make some money off of it because I'm going to recoup from the insurance. So there was so much there where it's like, this sounds good. And I know there's a ton of impressionable, because I went through the comments and there are a ton of impressionable young people who are like, my God, you changed my life. I'm going to do that when I grow up, blah, blah, blah. And it's like, I'm glad that you feel empowered to want to be successful. This would be my answer to them, or my advice to them. It's good that you want to be empowered. It's good that you want to be successful. It's good that you want to think like an entrepreneur. I think that's a great thing. I promote that literally in my own business every day. However, the worst thing you could do as an entrepreneur is think that you know it all. Because even us, we don't know it all. That's why we have crews of people that we work with or directly for on certain deals, because they're the experts in their subject matter, just like we have our subject matter experts. You don't come to me for real estate advice, right? Because you're the expert in the matter. Now, you may come to me for like business planning around the real estate advice, like, hey, what would you think would be strategically best, blah, 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 blah. But the point I'm trying to make is, in order to be a true entrepreneur and be successful, is you have to have a crew of people that you can go to. Maybe not tell them everything. You don't have to trust them with your deepest, darkest secrets, but you have to have a mutual respect and trust for each other, where if the situation comes out, who can I call that's an expert in this matter? Because the expert's going to tell you that that does not happen in any reality, where all of a sudden I can buy $300,000 for $15,000. And I see this stuff all the time on my YouTube coming up.
Yeah, it's very popular right now.
And it's like, I know a lot of lenders. I know a lot of bankers that are currently and still doing it. And I don't hear these stories from them often. I do hear people coming to them saying that they would like to do those things, and then they're like, "Yeah, it doesn't work that way." But
I think the only way it's possible, right, is if he does it seller financed. I think that's the only way.
the seller has to carry the note. And when the seller carries the note, that seller's not going to want to finance it for 40 years. That guy's not trying to do that. He wants
it's typically
10-year cap. It's a 5-10-year cap with a balloon. For those of you who don't know what a balloon is, a balloon just means if I set the loan for 5 years, you're going to make X amount of payments for 5 years. And then at the end of the 5 years, if you don't pay it all up front, I get it back. Those are really bad deals. I actually have a story to share about one of those right now. I'm currently working on getting an insurance brokered for a buddy of mine who called because he's a manager of a construction company. He's a foreman, essentially. And the builder just built a brand new home in LA, $6.5 million. They took a construction loan that was hard money construction because none of them individually qualified to get it by themselves. So they ended up taking an investment pool of like 10 to 12 other people or however many other people to be qualified to get this loan. These loans need to be refinanced immediately. And and I was actually talking with a client yesterday about this. Lenders are very predatory when it comes to selling. You know that it's a predatory loan when the first thing comes out of their mouth is, "Oh, well, don't worry. It seems high now, but you could always refinance." If somebody's telling you that,
worry
and
run.
Because the reality is if you truly could refinance it, you would have a better rate. Because it means you don't qualify for a good rate now. So that's why they're telling you, well, don't worry, you can refinance it. It doesn't just work that way. Refinancing, for those of you who do not know or have heard the term, is if I buy something from Payson and I give Payson, let's say it's his laptop. His laptop goes for 10 grand. On the market, 10 grand. And Payson goes, "You don't have 10 grand on you, but I'm going to give you an opportunity to pay it in payments. So I'm going to charge you the 10 grand plus 27% interest. So you owe me 12.7 now." Okay. Let's say it's a 5-year loan. So I'm paying whatever I'm paying to the point of $12,700. Halfway through my loan, it's a 5-year loan. 2 years later, I still have the same device, but this is now 3 devices ago. Okay, and the new device is barely worth $10,000, and I have an old one I'm in the hole for $12,700. I go to a bank and I say, "Bank, I'd like you to refinance this laptop for me." They're gonna say, "Okay. This laptop in today's market goes for $5,000. Oh, but I owe 10 because I've only been paying it for 2 years, and most of the amortization went towards interest, not principal. Yeah, I'm sorry. You're stuck with it. Nobody wants it. They don't want something that's owed more than what it's worth. That's just basic business 101. So when you're buying a house or a construction loan, that's inflated value. Unless that thing appraises for more than what you purchased it for, you cannot refinance it. There is not a planet in which your old Dodge Charger Hellcat is worth more than that 30% interest loan that you took for 8 years. I have met countless young people who pay their car payment and they have to work just to pay their car payment because it's like in the excess of $1,000 for 7 years.
It's insane.
And they're, what did the salesman always tell them? It seems like a lot now, but you could just refinance it in a couple years. Oh, yeah, that's great. If only it was that easy.
Yeah.
Understanding lending, understanding business, understanding the ways to make things beneficial for you and the things that you like to do requires planning, right? We talked about this in one of the podcasts where we talk about how do you do business. You plan. You strategically plan, you place things ahead instead of getting the vehicle and then worrying about the refinance in 2 years. Think about getting the vehicle, play out the scenario, mind map it, and ask yourself this question. In 2 years, is this car going to be worth what I owe on it?
Nope.
What's the first thing people say when you buy a car?
as soon as you drive it off the lot, it depreciates.
I didn't even have to cue a tip for you to remember that because you remembered it.
Yeah.
So we're already depreciating. It's a depreciating asset, right? And people love, I see this all the time where they say credit isn't a liability, it's an asset. Debt's not a liability, it's an asset. Fine. There's an argument, a minor argument there to be made. But from an accounting standpoint, the debt is a liability because you do not own it outright. Therefore, it's not your asset. It's the bank's asset. So as much as you want to say, yes, it makes me passive income. Yeah, sure, it makes you passive income. But if push comes to shove, it's the bank's.
Yeah.
At the end of
Yeah,
the day.
if you don't pay it.
Until you're done paying it off, it's still the bank's. They're just allowing you to use it for the time being. So there's argument to be made that assets and liability, but that's not what this podcast is about. This is more so just the thing you drive off the lot is already depreciated. On top of that, you have an exorbitant interest rate that's been placed on it because you are not a credit qualified person. Either your credit's too low, your credit's too new, your debt to income is too low, whatever those factors are. Typically speaking, when debt to income is too low, they ask you to put more down, right? Because the ratio legally has to be under 42, 43 max.
I think, 42.
So how do they make you close the gap? Well, they can only close the gap.
Do a rate buy down, or you just put more down.
And those of you that do a rate buy down, it's not a bad thing. I've actually done a rate buy down because it made sense because I had so much equity in one of the homes that I owned that it made sense. I purchased at $262. It's now worth $570. And I've talked about this where I put 3% down as an FHA, took whatever cash I had, completely remodeled the home. In a year and a half later, I got it reappraised. It appraised for double what I had purchased, and I got rid of PMI. In a year and a half, I saved myself $650 a month on a mortgage payment. That didn't just happen. That was mind mapping.
Yeah.
I knew what I was doing from before I even put the offer on the home, right? I thought about it.
You had it all figured out.
This is way undervalued. I'm going to put 40 grand, instead of putting 40 grand into the loan, I'm going to put 40 grand into the house because I can manage the payment regardless. It doesn't make a difference for me to pay $200 less. $100 less doesn't make it better for me. $600 less.
That does
makes it a lot better for me. When you factor in that a 30-year loan saving $600, I'll take that all day.
Yeah.
All day. These are things that when you're talking about getting into business, people ask these questions all the time. We get emails, we'll get asked in person, what should I do to start a business? What should you do in life? Pre-plan. I understand there's spontaneous things, and I've said this before. If you're young, take a spontaneous risk. You have something to fall back on because you don't have a family to keep fed. You don't have a home to keep up. You can go sleep with your parents. It's no big deal. If I was in that position, I would be taking a lot more risk now that I know what I know over the years of learning because I would be much more aggressive in my risk taking. But I can't do that. So that's okay. So now I teach it. But the misconception of lending it's not just that simple. It's very complicated. Any of you that have done some sort of lending, have done some sort of business dealing, whether it's buying a home, whether it's selling a home, whether it's buying a car, it's not just so cut and dry.
No.
There's a lot of...
I've had clients where you have to pay off credit card debt, you're paying off a vehicle.
Yep.
Sometimes you're selling the vehicle so that way your debt to income can actually make sense. And sometimes it doesn't come up till middle of the transaction. They think everything's fine, and then somehow something changes all of a sudden.
Yeah.
And it's like, oh, shoot, you're no longer at the proper debt to income. You're going to have to do something about it.
And private lenders, especially seller-back carry, they don't want to carry that note for forever.
No, it's typically a balloon after maybe 10 years.
I have seen 10 years on over excessive $1 million. And it was a young person who inherited the property from their father, died, and she went into money, a lot of money, millions and millions of dollars. So for her, it was okay. I'll carry it.
And there's one I did hear from a guy I knew in LA. He bought, I think, a couple houses from this lady, and she was older though, like really old. And she just didn't want him to refinance the loans until she had passed away, apparently. So that way she could still receive retirement, essentially. And I think it was a little longer than 10 years, but it was like a very circumstantial case where she's like,
yeah,
hey, please.
you have that.
Yeah.
But that's a blue moon.
Yeah,
you know,
that's
those
not
are
typical.
Those are one you pull in the hat and you're like, that's a story for the boys down the road. You know, nobody would ever think this would happen. And you know, I am sure, I can't think of any right now, but I'm sure there's some that I've been a part of too. But it's just like, it doesn't work that way. I have seen people who make $15 million a year get declined for $100,000 because the way they do their taxes. Mm-hmm. The first advice we gave them, go do your taxes the right way so you can actually qualify. Well, I make $15 million a year. No, you don't. Your net income every year is $200. You want $100,000 for $200? It doesn't work like that. I don't care. The bank doesn't care that you drive a Ferrari, that you have $1 million home, and you have another $1 million home, because what you tell the government is you only make $200. Mm-hmm. So that's what they go off of. That's what all lenders go off of. Even if we're talking ad backs, there's only so many ad backs you can do. You just can't. You can't turn 200 into 15 million all of a sudden without, you know, it's like, so what are you doing here? It's just really interesting. And I think this is going back to the social media thing. This is why I think social media is dangerous. It does teach you a lot.
Yeah, this is what we kind of were talking about last time.
Yeah, it teaches you a lot. But it teaches you the wrong way. It teaches you the embellished way. Nobody actually sits in these podcasts and goes, it was a very difficult task. It took me 10 years just to get this one building. Mm-hmm. Because that doesn't sell. Nobody wants to put in 10 years to do one thing.
Well, that's like I was talking to a guy the other day, and he's built up this massive portfolio, but it's taken 33 years.
Right.
He's like, and it's taken the full 33 years.
Yeah.
There's nothing fast about it.
Exactly.
It was blood, sweat, and tears every single day.
And he took losses, and he won some, he lost some, and it took a lot of saving and planning and strategy. Mm-hmm. It doesn't, you just don't walk in snot-nosed, I'm here, here's 16 grand, everybody, where's my building? I see this crap all the time, and it's just bull. It's bull. If somebody were to go and do forensic investigation on the way that these guys make their money, I guarantee you it's not the way that they say.
Well, they all these guys have courses now too. They make so much money off of selling that course. I know someone that signed up for his course actually.
And how's he doing? Is he a millionaire?
No. And it was an $8,000 course.
Jesus Christ. I thought that Tate course was the expensive one, but that's
how much is his?
$50.
Oh,
I thought that's what these guys charge.
That.
Cardone does this too, by the way. That Grant Cardone guy, in his videos, he says that he bought a $600 million building. I know, and you know, we both know investors that have actually gone in with him. Yeah. The majority of the money was their money, and they have said he's a garbage person to work with.
Yeah. I saw someone's post. This was a post the other day, so I mean, it could be wrong, but this guy said he put in $5,000 on one of his apartment complexes. He said that like the update they get is just literally like a sent from my iPhone, and it was like 10 words that he said, and like the return on his money is like 3.5%, if that. Like it's super subpar.
I could get you 3.5% today on a liquid savings account at Capital One. Between 3 and 3.5 on a liquid saving. You're better off putting it in their hands than you are putting it in his hands. The reality is this, guys. If it sounds too good to be true, this is the old homage. It is too good to be true. I encourage and I implore you to do a little bit more information about the true technicality of the subject matter at hand, not just what some person says. And you know what? Go ahead and fact check me on some of the stuff I'm saying, because I'm giving you a decade worth of experience. But things change every day, and maybe through the grace of God, things have completely derailed and they really work that way. Because if you come back and you tell me I can get $300,000 for 16 grand, I'm going to go buy so many buildings by the end of this next month, and I'm going to own half this town. For 16 grand every building, I'll take that all day. And we'll go in on it together. We're going to be the slumlord landlord, dude. I don't care.
Paint over everything.
Everything. I'm going to paint over the fires, building, and everything. I'm going to put some plywood out there and just paint. It's good. If it's good for Ryan, it's good for me. So, I hope that it taught you guys a little bit of something about today. Again, there's a lot of misconceptions. If you want to choose the topic for the next one, join our membership program. You get to meet with a business consultant once a month. We talk about you and your goals, your business, everything that, keeps you going. And I want to thank USCCA once again for being a sponsor of this channel. We appreciate them. Payson, I appreciate you. We're going to be working hopefully a little bit later today on a different podcast that's going to be coming out here pretty soon. But yeah, we hope everybody has a great rest of your day, and we'll see you on the next one. No bye. You're not going to say
adios.
Thanks for listening to Man in the Middle. If you haven't yet, please consider liking and subscribing to the show. If you can't wait till next episode, follow us on Instagram at MITM Business Consulting and online at mitm.services. There, you can learn more about what we do, how we can help, and the custom services we offer around your personal needs. Until next time, if you'd like to choose the topic we discuss and receive additional services, consider joining our membership program at mitm.services. Disclaimer: Man in the Middle expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast. We look forward to you tuning in next time.